Golden Prospect Precious Metals, or GPM, offers specialist exposure to the producers of gold, silver, and the platinum group metals. GPM is the only investment trust exclusively focused on this sector and has a market cap of just under 120 million at present. The gold mining industry is far larger by market cap, and it's where the portfolio tends to concentrate. Mining is an industry with relatively low analyst coverage, which means it should be more likely to repay active management, and it certainly has done in GPM's case. Additionally, as an investment trust, GPM can take on gearing, which is another advantage it has over an ETF, which has led to outperforming passive options over the longer term. The trust tends to focus on the smaller and mid-cap companies in the index in pursuit of outperformance. Golden Prospect Precious Metals was the top performing investment trust in the entire sector in 2025, with a NAV total return of 170.5% in the context of the gold price rising 53%. The trust outperformed the main gold mining ETFs, as well as more generalist mining trusts. This followed a period of strong returns for the gold price in 2024, when the miners were lagging. With gold prices significantly higher and inflationary pressures on miners having reduced, investors may have finally been attracted by the strong cash flow in gold miners. Performance has historically tended to come in bursts for GPM, and share price and NAV returns can both be volatile. In particular, it has tended to outperform the passive options in rising markets and underperform in falling markets. For example, it delivered strong outperformance of the junior miners ETFs in 2024 as a whole, and in 2025, but underperformed in the weaker markets of 22 and 23. And if we look further back, in 2019 and 2020 were great years for the sector, and GPM delivered massive outperformance. In our view, this performance pattern is rooted in the small cap focus and the use of gearing, and it underlines the return-seeking nature of the trust, which is most likely to suit those looking to maximize capital gains, but being willing to take risks. A particularly extreme example of this volatility came in March 2026, when the NAV fell over 20% as the gold price fell 12% in the month. But despite this, GPM remains up for the year, which really underlines the potential for performance, but also that investors need to have the stomach for volatility. The strategy is highly active, involving buying companies at attractive valuations where there is a catalyst for a re-rating. In the rally of 2025, activity mainly focused on trimming and taking profits in positions that performed really well and rotating into others that had been left behind. A focus on valuations means that M&A can often boost the portfolio, as it did last year. In fact, the managers have tended to look for companies that are able to fund their own growth internally through assets they own, and that often makes them a target for acquisitions. More recently, the managers have reduced their exposure to miners with heavy exposure to higher energy costs and taken down gearing a bit in the light of the risks. Also, the exposure to silver is higher than it was last year, at around 22% of the portfolio, up from 12% 6 months ago. Despite the volatility seen this year and the reduction in gearing, the portfolio continues to have around a third in explorers or developers, meaning companies with assets at an earlier stage than the more mature producers. And this reflects the continued confidence in the gold price, incentivizing the purchase of new supply. Arguably, the long-term drivers for gold remain intact, including sustained central bank demand. Central banks are looking to diversify their holdings from the dollar, and ongoing conflicts involving the US really seem likely to increase this. Similarly, persistent inflation means a debasement of the real value of fiat currencies is a concern. And in the medium to long term, inflation would easily be a useful tool for governments to get rid of their debt problems. In the short term, the managers highlight that despite this pullback of around 12% of gold in March, the producers still look attractively cheap. First quarter 26 gold prices averaged around $4,900 an ounce versus fourth quarter 25 of around $4,200. So there's still continued earnings and profit momentum. A key near-term consideration for the sector is the impact of higher oil prices on operating costs following recent disruption to energy supply routes. This will create inflationary impulses over the coming months, reducing the likelihood of rate cuts and may also have negative implications for the global economy. This means, therefore, that it could be supportive of precious metals' defensive properties too. So there's a double-edged sword. Given the balance of risks, the portfolio has maintained relatively low gearing and is focused on assets that are less exposed to energy price volatility. To keep updated on gold and prospect precious metals, head to the Kepler Trust Intelligence website.